Good morning, good morning, good morning. I'm Frag.
And I'm Gill.
And this is Frag and Gill Podcast and Radio Show. Today, we are getting into the meat and potatoes, aren't we, Gill?
Yes, sir. What you got for us today?
Today, we got investing. You know, I figured that this section, which is going to be a 3-part section, is some of the most invaluable information that we can provide our listeners. What do you think?
Yeah.
I wish I would have had this information starting out. What do you?
Oh, yeah. If I had this shit when I was 18.
Oh, yeah. Be a lot more financially stable, and our money would be making a lot more money.
Yep.
So, let's get started.
Let's do it. Go on, Kramer now, bud.
All right. Let's have at it. So, investing part 1. Gil, what does investing mean to you?
It's putting your money in something, makes you more money, increases your value.
That's right. So, you said something, so let's look at those somethings. So, when you're looking at, so what is something? Those somethings are called assets.
Assets.
All right. So, there are multiple assets, right? But your major, so what is the definition of an asset? An asset is a piece of property regarded as value. And these properties are broken down into classes.
So what was it of Rich Dad, Poor Dad? Robert Kiyosaki said what asset was something that adds value and makes you money or holds its value. As where liability is pretty much just taking money from your pocket.
Exactly. So for example, my house and Gil's truck are not assets. They're liabilities because we use them every single day. All right. So financial asset classes. So you have cash, euros, fiat currencies, anything that's used as an exchange of money that isn't a precious metal, basically. All right, bonds. Tell Gil, go ahead and tell the audience what a bond is.
Bond is pretty much like a loan. So you're going to buy into that thing and it's going to have a maturity date. When that thing matures, you're going to get your money back. You'll probably make some interest along the way, but they're relatively safe. So, man.
And who gives out bonds?
You get government bonds, corporate bonds. You get all sorts of different bonds from like your local governments, like cities, counties. You get federal government, like treasury bonds. You get all corporate stuff, or let's say Apple. If they want to issue bonds, they can. But they'll pay you. Like they might give interest. I don't know. You'd have to look into it and see.
Do your own research.
Yep.
And then finally, stocks. Stocks are a financial asset. You're buying a piece of a company and investing in it, and it returns your money. All right, moving on. So you have tangible assets. These consist of real estate and commodities. Real estate is a piece of dirt. It doesn't always have to be a home. It doesn't always have to be a business or a building. Real estate is land. It's something you can touch. That's what tangible means.
You know who's got some really good real estate? McDonald's.
Technically, McDonald's isn't a burger in
no,
a burger
real
joint.
Estate.
It's a real estate company.
The thing about it, they got the hottest piece of dirt wherever you go, sitting on the corner, wherever.
Yeah, from Times Square to Tokyo. I've been to roughly 15 countries, and I would say at least 12 of them I've eaten a Big Mac in them.
Oh yeah.
Um, Commodities. So, Gil, can you go into commodities? What are some examples of a commodity?
You got your precious metals, jewelries, and that kind of stuff.
Mm-hmm.
So yeah.
You also oil is a
Oh, yeah,
commodity.
oil, yeah,
Wheat,
gold,
yeah, gold,
gold.
silver, copper is going to be a big one we're looking
Hmm.
at. It's relatively cheap. You can get a pound of it for about 16, 17, to even $20 roughly. Um, as the world becomes more electric, you're looking at copper is going to be a big player, and
Yeah, copper, silver is going to be big players into that
because of their uh, conductivity,
conductivity.
yeah, something like that. Um, Wheat, barley, even hogs, commodities.
Just but food.
Yeah, basically. So the risk return relationship. What is the risk return relationship? So from left to right on the screen as you see it, you can see the the least amount of risk and return to the most amount of risk and return. So cash. So cash has no return, but it also has no risk. So let's say that you keep $1,000 in cash in your safe due to
Inflation.
inflation, which is roughly 1.7% per year. You're losing money over time.
Yeah, losing buying power.
Yes, buying power. Yeah, excellent,
Mhm.
excellent term. So, moving on, bonds. Bonds are also pretty without risk. They pay a little interest. You're holding debt of a company or
Or the government.
or the government. The United States of America's debt is not going away anytime soon.
No, no, not at all.
Not at all. So stock,
But
stock.
they're trying to devalue it though.
Oh, absolutely. And due to
Hashtag
inflation,
inflation.
absolutely. Stocks. So stocks is a beast in itself, and we will go dive deeper into stocks and what stocks are, how you can invest in stocks, and the differences in between them. So you have your risk and you have your reward. If you're shorting stocks, you have you can have infinite losses. Um, if you're going for a long approach of stocks, you can lose everything that you've invested. All right. Um, Real estate. So real estate, it's very, very expensive. Um, but I mean, it's a tangible asset. It's something you can hold. And then moving on, commodities futures contracts. So commodity futures contracts are very high risk because of their volatility. 2 weeks ago, gold was sitting at 1960 an ounce, 1,960. Right now, gold was about 1,700.
Yeah, that's what I seen yesterday,
Mm-hmm.
I think.
So very volatile. Silver's the same way, very volatile. And what a futures contract is you're betting on the price in the future of what the commodity is going to be. Is it going up or down? If you hit it right and you strike gold, then you done made out right. No pun intended. All right, so now we're going to transition into long versus short positions. We're gonna first focus on long positions, and this is what most investors dabble in, and this is like if you're investing for retirement, if you're not an active investor there's no such really or a day trader, should I say. um, this is really what position you're going to be. This is the position Gill's in, and this is the position I am in. So a long position, you're buying an asset hoping that the price increases in value. Gil, can you give us an example of a stock that you've bought that has increased in value?
Apple bought it row, and it was in low hundreds. They
Mm-hmm.
shot up to like 400 something.
Mm-hmm.
But got all well, more or less on paper.
Mm-hmm.
made that money, and they did the stock split, and it's still going up in value now.
And
So,
you were able. So can you explain what a stock split is?
so we'll make it simple. We'll say you got a stock that's worth $400,
Mm-hmm.
and the company says, "Hey, we're gonna give you 4 shares, or every one share you have at $400, we're gonna give you 4 shares,
Mm-hmm.
and that'll bring that price back down to $100 a share." And I think their intentions are to have get more people able to buy into it at $100 instead of having like somebody wait and save up money to buy one share at 400.
Mm-hmm.
So you don't see it very much in the stock market these days. Apple did it. Didn't Tesla do it not too long after
Tesla
that?
did
Yeah.
it. Companies like AT&T have done it, but they've only done it 3 times in their history.
Yeah, I think the last time they did it was what, 20 years ago?
Yeah, 98.
Yeah, over 20 years ago.
Over 20 years ago, yeah.
Mm-hmm.
A split that may be coming up here shortly would be an Amazon split.
Yeah, that'd be one to watch.
Even if they split 5-1, their stock price. Echo, what's Amazon's stock price?
As of 12:16 p.m. Eastern, Amazon.com traded at $3,364.84 on the Nasdaq, down 0.05% since previous close.
So $3,300. There's not a lot of individuals out there that can buy that.
Yeah.
You know,
I'd like to see it if they do a split. I'd like to see how they like divide it up at that price.
yeah. I mean, they could do a 10-1 split and be perfectly fine.
Mm-hmm. Just like on Apple when they announced theirs, I think it was the end of last year.
Mm-hmm.
As soon as they announced it, that price just skyrocketed.
Oh yeah, because people
Like,
are
dang.
just getting in, and that's going to, and actually that information is going to correlate with another one of our topics later on.
Yeah.
So profits increase as stock value increases. The buy low, sell high method. So for example, you're hoping that you buy, let's say you buy AT&T at $20 and you hold it for, I don't know, a year, and it bumps up to $30 and you decide to sell, your profit is $10.
Another thing too, if I hold it long term versus like short term would be taxes, but I ain't gonna get into all that.
Mm-hmm.
That shit's subject to change year to year.
Capital gains tax and yes.
Okay. Yeah, that's one of those. Do your own research on taxes, because we could tell you one thing and it could actually be something else. Y'all know how taxes go. They don't know how to make up. They don't make it easy.
Do your own research.
Mm-hmm.
Okay, so most investors choose this method. Why do most investors choose this method, Gill? What do you think?
You don't have to worry about it. You just buy it, let it sit, let it do its thing. Come back another 6-8 months later. Oh, okay, that's cool. It's gone up in price.
Right. So I see it as it's kind of like bottom fishing for catfish. You set it on the ground and you forget it. You set and forget. You sit back. You drink a bush latte. You put in a dip ski. You do whatever you want to do, and you let your money make money. What I would say is that you have to remove your emotions from investing. That is the number one thing. Is you sit and you watch it. You just watch the market.
It's like waiting on that goose to lay that golden egg.
Absolutely. All right. So the maximum losses is whatever you invest. Like I said, you need to remove your emotions when you're investing. For example, if you had money in the stock market, let's say you had your life savings in the stock market at the beginning of 2020, and you had $100,000, and you had banks, you had a bunch of aerospace and what have you, right? And when the pandemic hit and when we had that big crash in March, you would have seen your portfolio drop by 65%. 65% is what it dropped during the Great Depression. So keep that
The
in.
thing about all them people that panic sell, and not is that market recovery like not even a month later. Now
Yeah.
it's back up to all-time highs. It's like, man.
And that recovery is called a V-shaped recovery because it falls fast and it rises back up real fast within a
Remember
matter of
that?
a year.
You got that little topic, buy low, sell high. When the market does that, that's when you want to buy.
Yeah, that is when you want to buy.
Mm-hmm.
All right, so continuing on.
Oh, that's another thing too. Don't try to time the market. It's really hard to do.
Exactly. And timing the market will be in part 2.
Mm-hmm.
All right, so short positions. So short positions are complicated, very, very complicated. So the very first short position that is known to have happened was in the Netherlands during the height of the Dutch Empire and the Dutch East India Company. Well, there was this individual who decided he was going to short the Dutch East India Company because they had basically kicked him out of being able to trade. So he shorted the stock. He was betting against them. He was selling rather than buying, hoping that the price would decrease in value. Well, guess what? It didn't. And he lost everything. And even on his tombstone, it says that he was a businessman that made a lot of money, then lost it all on his tombstone. That's one way to be remembered, huh?
Right.
Huh. All right. So when you're shorting a stock, technically you're borrowing the stock. So let's say that Gill wanted to short a stock. He bought it from me, and then he was betting that it would go down. It goes down, and he gives it back to me, and he keeps the profit of the difference from whatever is in between. So you're expecting the stock's value to go down. So, for example, there's an individual, a Wall Street hedge fund manager that found a Chinese company that was a fraud basically, and they were doing online education, but they weren't submitting out any education, but they were pocketing the money that they got from their gains on the stock market. He did his research. He found out that they were a fraud. He was about 85% sure. He borrowed a bunch of stocks to short them. And what he did was he wrote an article on his findings, and the stocks fell. He made his profit, and he gave the stocks back to their original owners. All right. Profits increase the further stocks goes down. We just discussed that. And so your maximum losses are theoretically infinite. So let's say Gill wants to short Apple, which is a pretty bad idea at this point.
Right.
So he wants to short Apple, and he buys at 150 a share, and Apple just keeps going up and up and up and up, and it could get up to $1,500 a share. Gill's going to have to pay back that difference to the original owner. So theoretically, your losses are infinite compared to a long position where your losses are whatever you've already put in. So we're going to give you an illustration of shorting, a short accounting pretty much. So the beginning stock price is 100. So you borrow the stock, you hold it. The end price is 50. When you're doing shorting, you're going to have to pay interest. You're going to have to repay the dividends if there are any dividends, and a commission. And then just to make the math easy, this is the way we've presented it. And since you borrow the stock, and then once you give it back, since the prices fell, your profit is going to be $40. All right, so the efficient market hypothesis. So this is kind of where Gill touched on earlier, and I'm going to go over this in depth. So the efficient market hypothesis was made by Eugene Fama back in the 60s. it basically says that the share price reflects all realized information. So, Gil, can you elaborate on what that means?
So you could have, let's say Apple makes an announcement about something that's going to be released in, let's say, end of the year.
Mm-hmm.
You could have people go in and start buying that share, and that would go ahead and factor in that happening.
Mm-hmm.
And whatever gets released at the end of the year, stock price don't do nothing because it's already factored into the stock price.
Excellent. So the efficient market hypothesis hypothesized that markets are efficient because all relative information has been factored in. So if EMH, efficient market hypothesis, is true, it is impossible to beat the market because all news has been priced in. So we're going to look at three different efficiency factors from weak, semi-strong, and strong. But first off, we're going to look at EMH, not to get too far ahead of ourselves. So, Gil, can you give us an example of an unexpected event?
Oh, natural disaster, lawsuits, stuff like that.
An interesting circumstance also would be the BP oil spill.
Or man-made disaster had that in there.
Exactly. So it shot the price of BP's company. You know, Gil, can you do the illustration you did earlier?
Right to the bottom of the ocean.
Right. As the oil rose, the stock price fell. So that is a real life example of an unexpected event and how the EMH would factor in. As Gil stated earlier, Apple announcing its new iPhone 50 or whatever it's going to be. Um,
Yeah, they're getting up there for iPhones.
Yeah, absolutely. So it's been leaked. The information is out there. Everybody knows what's coming. We've already anticipated it, and the stock price really doesn't really fluctuate when it does drop because it's already been, factored in and evaluated. Yes. All right. So EMH continued. If EMH is true, you cannot beat the market. So if that is true, you invest in low fee index funds. Why would you invest in a low fee index fund if EMH is true, Gil?
About all damn market.
That's right.
Index fund.
If you can't beat them, join them. And
exactly.
That's what
buy it all.
Buy it all. So if EMH is not true and you can beat the market, the way you invest is you pick individual stocks or mutual funds, which are managed portfolios by professional investors. If mostly true, it is difficult to beat the market, and your investment strategy depends on how true you think EMH is. Gil, how do you feel about EMH? What is your investment strategy?
Looking at this here, I'd say you can beat the market. So it's not true, but you also know it's can true from like other stuff we've been talking about with the fact shit getting priced in and whatnot. So I mean, it's probably mostly true. If you hold like index fund and like some stocks, you probably end up doing all right, maybe. Mm-hmm. So don't put me on that, people. So I mean, it's all in how it's all in how you perceive the research that you do. Mm-hmm. On stocks, index funds, bonds, whatever you want to hold.
Right. So the likes of Warren Buffett has beaten the market many times. Yet, if you look at his most recent data and how he has been investing recently, I mean, he is a 90-year-old man that has multiple billions of dollars. So, I mean, it's not like he's chomping at the bit or as aggressive as he was prior, but I mean, it can be done, but it's rarely done. And as we've covered in one of our videos before, that about 5% of all professional investors are able to beat the market due to their inside information.
Or it'd be like 2020, everybody beat the market in 2020.
If you were in at a certain period of time.
Yeah. If you bought in like last March, you're beating the market right now.
There you go. If you bought in in January, you're beating the market.
Yeah.
So,
but again, it's bad. You really can't time the market either. But you said that's for the next video, so we'll get into all that there.
Right.
So,
all right.
Before we digress on that topic,
we'll get into the efficiency of EMH. So weak efficiency, when you're looking at the weak efficiency of the market, so reflects all prior prices and movements. Past prices have no relation with future prices, and past performance is not a predicator to the future.
So like we said, the example of 2020 for that last bullet point.
We know for a fact, and it has been seen because we've had the real estate crash of 2008, the dot-com crash of the late 90s, early 2000s, the Great Depressions. Markets are inefficient. All right, so you're looking at types of efficiency, semi-strong efficiency. So stock prices have factors in all available public information. For example, let's say Apple spontaneously comes out with a brand new microchip that's going to make you a bionicle, basically, right? That's going to shoot the price up because everybody wants to be superhuman. Well, that's why Marvel is so popular, you know? We're fascinated by it. All right. Impossible to use past performance to predict the stocks of the future. People like to say history tends to repeat itself. Well, that is both true and not true. You look at past events to reference the present because some things do correlate, and humans are creatures of habit, since we created the stock market, it is a creature of habit as well. Yet due to a semi-strong efficiency with EMH, it is hard or impossible or almost impossible to use past performance to predict the stock's future.
You can't predict the unpredictable.
There you go.
I'll make my 10-year prediction for the stock market.
Ooh,
it's going to be up and to the right.
Historically.
Yeah. Historically, yes.
Historically, you're backed, you know. You're backed. All right. So, and then finally, strong when you look at types of efficiency. So, all public and private information is incorporated into the current stock price. So, Gill knows things that I don't know, and I know things that Gill doesn't know.
That's the way the world works.
And really, yes, that is the way the world works. And if we're both investing at the same time, we are driving the price of the market on our investments and the price of the individual stock on our investments due to our relative information that is known. Yet, that assumes that markets are perfect. And we know that markets are far from perfect. Because you'll have the panic sells of early 2020, March 2020, from about March 20th to March 23rd, the market had pretty much bottomed out. And if you had, I wish hindsight being 2020, if you were able to take $100,000 and diversify your portfolio at that time,
you'd be set right now.
You'd be set for the rest of your life. All right. So this concludes part one of investing. Like I said earlier, this is going to be a 3-part video, and we let's stop share, and we're looking forward to sharing this information with you because this is pertinent, potent, relative information to what's going to make you successful and what's going to push you to financial freedom. Gill,
The sooner you get started with it, the better off you're gonna be later down the road.
Right. So Gill, what have you learned from our research thus far?
Mainly on the shorting part, just because that gets so confusing so quick, especially if that whole GameStop thing. It's just like what?
Mm-hmm.
And it's like, okay, if them dudes can do that, they're probably in the fire with the whole economy.
Yes, that is very true. So to kind of
Imagine, so you think about it, so what if they did that with like some big like bank, and then that bank collapses, then that just sets off a domino effect. Then there goes, look, it's 2008 again.
Yeah, absolutely.
Mm-hmm.
Banks have failed, yet now the Wall Street are full of fire jugglers because they know that the government will bail them out.
Oh yeah, absolutely.
So they're able to make more risk decisions because the benefits do outweigh the cost because they know they have that safety net.
So, Uncle Sam will just come cover us.
Exactly. I think something that I've learned and that I can apply to my own investment, portfolio is the fact that there are so many different assets out there. And if you look at, because you can buy like gold ETFs, silver ETFs, real estate ETFs, right? But they're still all stocks. For example, Gill and I, we're silver stackers, baby. We love our silver, baby. Love it. Oh boy, I love it. And why? And why do we love it? Because it helps diversify our portfolio.
Yep.
I'm not going to keep a barrel of oil in my garage.
Man, the way we going right now, we might as well.
I seen that it was at $60 a barrel.
Yeah, it's creeping up.
And with Texas being cold right now, it's definitely
going to go up some more.
Because them boys ain't out there working. Oh, they might be.
They might be. I don't know.
They might be. That oil field. That's some tough work.
They don't. They probably at least got the refineries going.
Yeah.
However, it's coming out to
the electricity. Like they don't have any electricity.
Yeah.
So, I mean,
I don't know.
Everything's computer based nowadays. Automation.
I think it's funny if they're blaming the wind turbines for that, where they all froze up.
Really?
Yeah. It's just like, huh.
I seen on New York Times where they said that they wasn't that, but who knows?
Yeah, who knows what's going on? I ain't going out there to find out. So
yeah, no kidding. They're always, that's. I was listening to a podcast yesterday, Rich Dad Radio Show. Check it out. Good information. They were talking about how they don't even allow their children to watch cable news because it's to the point where they're just protecting their positions.
Mm-hmm.
Warren Buffett.
And
go ahead.
Cable news is so full of shit.
Yeah, call it what you want. Yeah, call it how it is. Really,
It is what it is.
And that's another thing is that when it comes to politics, don't let politics influence the way you invest. For example, Warren Buffett is damn near 100 years old. He's been alive for a quarter of the time that this country's been, established. And he's a Democrat. So half the time that he's been alive there's been a president or a Congress that he didn't vote for. and that didn't align with his political values, but it never took him out of stocks.
Yeah.
You know, the market supports us all, and it can support us all if you get in, you stay in, and you just sit back and watch. If you're a fisherman, you know, it's like bottom fishing, easy day. If you're a hunter, you're not gonna go out there the very first time you ever hunt and go kill that massive 12 point with those 2 drop tines. It's not gonna happen. You have to wait, you have to sit, you have to do your research, do your preparation, make sure everything's right. And then when it comes time to execute, you must execute. This facet applies to everything in life. You know, everything we do in life, you have to almost sit back, watch, get learned up, and then execute. I mean, Gill, you know this. Like, I mean, can you even give us an example from your life of a time where you had to almost sit back, grit your teeth, and watch as like the world burned down around you?
It goes back to my hunting and fishing examples. To sit there, wait.
Mm-hmm.
Oh, there it is.
Yeah, no kidding.
Got him.
Yeah, I mean, you know, right now, like I said, I'm in university and it's terrible. I hate it, but I have to do it and I have to accomplish this because this is one of my life goals. It's one of my long-term goals that I've, you know, I want to be the very first college graduate in my family. And you know, it's not easy, but you got to do what you got to do, you know? Well, Gilbert, I think that this rant has gone on long enough. Do you have any comments to give our listeners?
No, I think we about covered it all for this episode.
Tune in here in about 3 days. What is that? How many hours are 3 days? 72?
72, yeah.
72 hours from this moment, there will be another recording. Part 2. Stay tuned because it's coming.
You better knock on wood now because now some shit's going to happen. That ain't going to happen.
All right. Well, this has been the Frag and Gill podcast and radio show. I'm Frag.
And I'm Gill.
Have a good day.
Deuces.